Most people think their credit limit gets decided after approval. It doesn't. In many cases, banks already have a limit range in mind. Before your application is even fully processed, before the card ships, before you ever swipe, before you even log in. Because modern underwriting systems are not reacting in real time, they're predicting your behavior in advance. Or in simpler terms, they're not asking what you did, they're asking what you're likely to do next. And once you understand that, credit limits stop feeling random. This is Credit Cipher, and today we're decoding how banks secretly decide your credit limit before approval. A credit score matters, but to lenders, it's only a summary signal, not the full decision. Because banks are not asking, can this person borrow money? They're asking something more subtle. How predictable is this person going to be with credit? Or in bank language, is this going to be smooth or something we'll have to manage later? That's where deeper underwriting begins. Issuers evaluate utilization behavior, account maturity, spending stability, application pacing, relationship structure, and risk consistency, not individually. As a connected system, think of it less like a checklist and more like a behavioral model running quietly in the background. That's why people with similar credit scores can receive completely different starting limits, because the score might match while the behavior underneath does not. One of the first signals banks look at is utilization stability, not just whether utilization is low, but whether it stays consistent over time, because consistency signals control. And control is what banks actually trust, not perfection. Just predictability, or in simple terms, boring behavior is actually a good thing here. The second signal is account maturity. Older accounts create stronger trust signals because they show long-term behavioral stability. Not, I optimized my credit recently. More like, I've behaved this way for years and nothing broke. That matters more than people think. The third signal is behavioral pacing. Rapid applications, fast balance growth, multiple new accounts in a short period. Those patterns increase uncertainty inside underwriting systems. Even if your score looks strong, or from a lender's perspective, it starts to look like volatility. And banks don't like volatility. From a lender's point of view, predictability reduces risk, and lower risk can support higher starting credit limits. Not instantly, but consistently over time. Then there's the hidden layer most people miss. How your accounts behave together, not separately. Together. This is where structured profiles stand out. Most people think banks only look at numbers, but structure matters just as much, because banks prefer profiles that are easy to interpret. Stable anchor accounts, controlled utilization, clear spending behavior, gradual account growth. Basically, a profile that tells one clear story, not 5 conflicting ones. That structure builds confidence. And confidence influences approvals, starting limits, future credit increases, and long-term lending decisions. This is why Credit Cipher focuses on system design, not shortcuts, because shortcuts can work temporarily, but structure scales. When underwriting systems evaluate your application, they're quietly asking one question. Does this profile look controlled? Or does it look unpredictable later? That single question influences more than most people realize. So let's connect everything. Before approval happens, banks are already evaluating stability, predictability, account structure, behavioral consistency, utilization patterns, and future risk. That's the system behind starting credit limits. Not luck, not randomness, just risk interpretation. The people who consistently receive stronger approval are not gaming the system. They're building profiles that make sense over time. That's the difference. And once you understand that, you stop chasing isolated tricks and start designing your profile intentionally. That's Credit Cipher. Next, we're going even deeper into something banks rarely explain publicly: how some borrowers quietly get labeled as low-effort, high-trust customers inside financial systems, while others stay stuck in average approval patterns no matter what they do. That's where the real separation begins. If you want to understand how banks actually evaluate people behind the scenes, subscribe and turn on notifications, because the deeper you go into these systems, the more obvious it becomes that credit scores are only the surface. And comment this below. What do you think matters more to banks long term? Credit score, profile structure, or behavioral consistency? I'll read every comment.